Hi everyone, welcome back to Helping Make Sense. I wanted to take a little time today to help you understand in a little bit more detail different types of funds. So you might have heard of mutual funds, exchange traded funds, or ETFs. I refer to these in some of my other videos around investing and what types of investments you should be looking for in your IRAs and 401ks. But I think it's worth a little bit of a deeper dive because there's tremendous value in you understanding exactly where you're putting your money. So let's start at the beginning. A fund just suggests that it's a collection of different stocks, bonds, or investments all into one. So it is not a single currency or stock or company. It is a collection of different investments all within one vehicle. A mutual fund basically pulls money together to buy different types of stocks, bonds, or other assets. What this gets us, and this is also true for exchange traded funds, by the way, or ETFs, is an automatic diversification, which means that we're spreading our risk out amongst multiple companies so that if one company does poorly or has to file for bankruptcy or some major event happens that really tanks their value, we're still okay because the other companies are hopefully doing well. So a mutual fund can have as few as 20 or 30 stocks, companies, investments in it, and can also be well into the hundreds. There are a bunch of mutual funds out there, so when you determine if this is right for you, which one to invest in, please do a little bit of research and make sure that you understand what is invested in that mutual fund. Like mutual funds, ETFs or exchange traded funds are also a collection of companies, again, sometimes as low as 20 or 30, sometimes well into the hundreds of different types of companies that can be traded just like a stock would. Generally speaking, the biggest difference between a mutual fund and an ETF or exchange traded fund is the fee structure. ETFs generally have lower fee structures, typically a fraction of a percent, whereas mutual funds have a little bit higher of a fee structure, generally closer to 1%, maybe 2 or 3, depending on how actively managed it is. Between these two, as far as which one is right for you, again, I definitely recommend doing a little bit of research to understand what the fund invests in, what types of investments or companies are purchased within that fund, and then determine for yourself, do you think this is a good approach to long-term investing? Generally speaking, most mutual funds and ETFs that reflect the broader US economy or perhaps even global markets, so companies both domestic and global, the funds will go up. It's very easy to just look up their historic track record to determine what has this fund averaged over the past 10, 20, 30, 50 years, if they go back that far. And then you should determine on your own, do you feel comfortable putting your money in that investment, given what you know about it to date and what it might look like in the future? As we know with investing, nothing is guaranteed, but the more data you have behind the history of an investment, the more educated of a decision you can make to project what that might look like in the future. You may have also heard the term index fund. I wanted to touch on this really quickly. An index is just basically an indicator of a certain sector of the market or a certain category or classification. A common example that you may hear about is the S&P 500 index, which is a really good, strong indicator of how the US economy is doing. So if you invest into an index fund, in this case being the kind of broader US market, that's effectively what you're investing in. Without getting into too much detail, there are other indexes that could be for tech or small markets or emerging markets. I would encourage you, if you're interested in investing in those types of indices, to just do a little bit of research, but an index fund can be in either an ETF or a mutual fund. So think of it as the mutual fund and the ETF are the vehicles, or we'll use the literal metaphor, the car that's driving the investments. The index or the actual investments are what's inside. And indices can be in either or both. If you've ever tuned into public finance channels or CNBC or any of the Wall Street discussions, you've probably seen what are called tickers, which are little collections of letters that represent different funds and stocks and so on. I'll post a few examples of mutual fund tickers and exchange traded fund tickers here in this video. And all those letters do is just represent what the investment is. A simple Google search will allow you to type out what is VOO, and you'll see that's a Vanguard S&P 500 ETF or exchange traded fund, which, by the way, is a pretty solid investment if you're looking for long-term sustained growth over the life of your investment. When we think about what types of accounts we would purchase these funds in, whether they're mutual funds or exchange traded funds, you can purchase them in pretty much any type of account, whether it's a 401k, an IRA, even a taxable brokerage account, or a 529 plan if you're looking to save for education for your children. The one or two things to know with that is if the plan sponsor for your 401k, so your employer in that example, the only thing I want to call out when it comes to these investments in different types of accounts is that if the account is sponsored by somebody else, let's say like a 401k, which is sponsored by an employer, that employer will determine which funds are offered. So you're a little less flexible as an investor as to which funds you can choose from. Whereas for an IRA, which is outside of an employer, totally separate, you can choose that on the open market, and you have many more options that you can choose from by way of ETFs and or mutual funds. So when you're doing your research on the types of ETFs or mutual funds that you would want to potentially invest in, I would definitely want you to consider, when deciding which ETFs or mutual funds to invest in and which account to do it in, keep in mind you want to look at the track record. How has this investment done historically? And also look at the fee structure. If you understand the investment, particularly for an ETF, and you feel confident with it and you think it will do well, it will stay with the market or even do better than the market, try to keep that what's called an expense ratio as low as possible. I've seen them as low as 0.1%, 0.03% in many cases, because that way more money comes back to you as the investor rather than to the institution that you're purchasing the fund from, something like a Vanguard, a Fidelity, or a Schwab. So just keep in mind, as we wrap this discussion up, you want to make sure you do just a little bit of research, a little bit of homework to determine how much the expense ratio is for your ETF or mutual fund. In what type of account are you investing in this, so that you understand the tax implications? And also, how has that investment done historically? Because I would argue that that's going to be the best representation as to what it will do in the future. Remember too that when it comes to ETFs and mutual funds, I would check them periodically, because if they are underperforming what you expected, you can take another look and sell it or sell some of it and just buy into another one. With that being said, if the entire market is down and your funds are down as well, that's probably logical, right? If you're watching this video at a time when the market's been down, let's say 10-15% since you started investing, well, then it makes sense that your investments would follow suit. But if the market has made, let's say, 20% in the past 6 months and your funds are making 13% on average, I might want to give a second look to that, do a little bit of research, do a little bit of homework to determine, okay, which investment or which fund can I switch to that will have a better upside over the course of the next 6 months, year, or many years. So to bring this all together, there's not a huge difference from the investor perspective of mutual funds versus ETFs. They're both collections of investments, typically stocks, maybe some bonds, and generally these funds will go up over time. Keep an eye on those expense ratios, understand what the investment is, what it aims to do, and ultimately just the fact that you're doing it and keeping an eye on it should produce positive results over the long term. If this breakdown is something that's a little newer to you, please let me know in the comments anything that is still unclear. It's always important to make sure that whatever you're investing in, you know what it is. In the same way that you would purchase a good or a service, you want to know what it is that you're getting. Same thing with investing. Thanks again so much for watching, and I'll see you in the next video.